Hi everyone, once again I'm back with some updates on today's economic reports. As I'm currently swamped, I'll let my virtual assistant take over yet again. If you're not sure what that means, all it means is that I wrote this transcript out for Descript's Lyrebird AI voice model, which was trained on my voice, to read out on my behalf. This helps me a lot as I'm not always able to record my own audio due to a noisy and chaotic home environment. Anyway, back to today's highlights, which will focus on recent figures on new car sales in the UK, updates from S&P Global Services and Composite PMIs, an overview of US factory orders for the month, and a look into the FOMC minutes. First on our list are the new car sales in the UK. This report is courtesy of the Society of Motor Manufacturers and Traders, also known as SMMT. As the key trade association in the UK's motor industry, they have reported a significant 25.8% surge in new car sales year on year, surpassing the market's expectations of a 13.5% increase. This 11th consecutive month of growth is largely attributed to normalization in the supply chain, where prior disruptions are no longer having a substantial impact. This normalization is especially noticeable in the fleet sector, which is made up of logistics and other transportation companies. A notable trend is the substantial growth in electric vehicle sales, plug-in hybrids, and conventional hybrids. While petrol car sales increased by 13.5%, diesel sales dipped by 22.3%. A very interesting point made in the report was the urgency to cut public charging costs for EVs. This is because current prices are 4 times the domestic rate, which is potentially a huge barrier for prospective EV adopters without home charging facilities. Another interesting point in the report was that Tesla's Model Y topped the UK's new car sales chart, with most of the demand arising from fleets and businesses. Next, we have the S&P Global Services and Composite PMIs, with services standing at 53.7. Despite being the lowest in 3 months, it indicates continued growth in the service sector, propelled by sturdy business and consumer spending, even among inflationary pressures. 48% of service providers were optimistic about business growth over the next 12 months, although positive sentiment has waned for the second consecutive month. Composite came in at 52.8, down from 54, showing signs of a slowdown in public sector output. New orders in the private sector saw marginal growth. It's also worth noting that backlogs for work fell at the steepest rate so far this year. The report also mentions that input cost inflation was at its lowest since February of 2021, while prices charged increased at the slowest rate in 26 months. Moving over to the US, new orders for US manufactured goods experienced a slight increase of 0.3% on a month-to-month basis, although this fell short of the anticipated 0.8% hike. This uptick was primarily driven by demand for transportation, especially civilian aircraft, ships, and boats. However, orders for non-durable goods declined by 1.2%. Due to transportation's dominant contribution, factory orders excluding transportation dipped 0.5% month over month, marking the 4th consecutive month of decrease. This was contrary to market expectations of a 0.5% increase. Okay, onto the FOMC minutes. These really came in better than expected, with a general sense that FOMC members basically agreed a pause was needed as the Fed looks to monitor the effects of its current tightening policy. Even the hawks ended up agreeing with a pause. It's important to note that next week we get a fresh CPI report, which will give us a glimpse as to whether inflation continues to decline at current rates. If it doesn't, then we're in for further rate hikes. A softening in wages was also seen, which is expected to lead to a softening in core inflation in future reports. A really interesting point made in the minutes was that staff saw the possibility that the economy could continue to grow. Slowly, but still they see the likelihood of slow growth as a possibility, noting it could almost be as likely as their prediction for a mild recession, which was anticipated later this year and has been something analysts have been trying to predict for some time now. Forecasts of a mild to a deep recession have ranged from anywhere between earlier this year, which obviously hasn't happened, to mid-2024. Another interesting part of the minutes was the discussion around housing. FOMC members talked about housing showing signs of bottoming out. We've been seeing home sales, builder sentiment and new construction all improving recently. The market has reacted by pricing in one more 25 basis point hike then remaining flat until next year. I think I agree with this outlook also. I think rate cuts are a long way off unless it looks like the Fed have essentially broken something, which would be something like another banking crisis or signs of a deep recession. Remember, the Fed are going for a soft landing, and right now that seems like they're in with a shot of pulling that off. In conclusion, the FOMC minutes did not come across as concerning. They were kind of in line with what I was expecting, and I think it was largely in line with what the market was expecting also. So anyway, that's all for this one. I will see you in the next update, and don't forget, if you are interested in checking out Descript and training the Lyrebird AI on your voice, follow the link in this video's description.